Hello. Today we're gonna look at the cost of capital, which is the chapter 12 of the class, and we will explain the cost of each capital, and then learn how to calculate the overall average capital or cost of capital. So, what is the cost of capital? Cost of capital is the cost to the firm for capital funding. It's basically the cost for the firm, and the cost for the firm is the same as the return to the investors. So the providers of those funds who are debt holders, so debt holder, liability holders, bond holders, right? And shareholders, they are stockholders. So this is the cost for the firm, but it's also same as the return for the investors. So really, we try to find the returns to the providers of these funds, who are the debt holders and shareholders, and that's the proposal of this lesson. And this return is entirely depends on the risk of this asset. So it is related to the risk. If it is riskier, then it's you require high returns, so the cost of capital should be higher. And the firm's cost of capital indicate how the market views the risk of firm's asset. So if the cost of capital for the firm is higher, then this company is riskier. Now, a firm must earn at least the required return to compensate investors, which means that, again, this is the cost of financing, right? So any project, like the project that firm pursues, should make at least this return. That's the minimum return level that firms should get. So it means that now this required return, the cost of capital, is actually the same as the pulp rate, the discount rate. And if you remember the capital budgeting, this is the discount rate that you need to use. So we start from the cost of equity. The cost of equity is the return recovered by equity holders. And equity holders are the shareholders who provide stock. So this cost is related to the return for shareholders. Right? And there are two major ways to calculate the cost of equity. The first one is the dividend growth model. The other is the CAPM, capital asset pricing model, that we learned in the previous chapter. So the dividend growth model approach is now, starting with the dividend growth model, the price is equals to next period dividend divided by, now this R is the required rate of return for equity holders, the minus G. So that's the stock valuation model, CDG model in chapter 7, right? Now we rewrite this for R, which is the required return, and this is also the cost of equity. And this should be D1 next period dividend divided by price plus the growth rate. So this is kind of the review, but we can use this formula to get the cost of equity. Now this is the example, easy example. Your company is expected to pay a dividend of $4.40 per share next year. So that's the D1. D1 equals to $4.40. And dividend has grown at a steady rate of 5.1% per year, and the market expects that to continue. So growth rate should be 5.1%. Now the current stock price is $50. What is the cost of equity? So just we use the cost of equity equals to D1 divided by P0 plus growth rate, and D1 is 440, P0 is the 50, and growth rate is 5.1%. If you calculate this, and it's going to be 13.9%. So that's that's how to use the dividend growth model to calculate the cost of equity. So the issue here is how to calculate the dividend growth rate. Now one method is just using the historical average. So for example, we have 5-year data here, and this is the dividend data in each. And as you know, the dividend usually do not really grow at a constant rate, but we assume that the average for the last 5 years may be good reasonable estimation of the constant growth rate. So each year you calculate each growth rate and then take the average. It's going to be 5.1%, and we can use this one as a constant growth rate. That's one way. Now, what is the advantage and disadvantages of this one? So it is very easy to understand and use because we have dividend information. We just use the formula that we learned in constant dividend growth model, but it has a number of disadvantages. Now, this model only applicable to the firms that paying dividend. If the firm does not paying dividend, then we don't have enough information to use this one. And also, it's not applicable if the dividend growth rate is not reasonably, constantly growing, which means that sometimes some dividend policy is pre-fluctuated. Dividend growth rate may fluctuate. Then we cannot use this model. Now, it's extremely sensitive to the estimated growth rate because you basically just increase by any percent point by adding the growth rate pretty easily. And then now does not explicitly consider the risk. There's no risk factor. Probably the price information is the only risk factor, but it's not explicit factor. It's implicit factor, right? So this does not have any risk factors that we can see. So that's the disadvantage. To overcome this problem, there's another approach called SML approach. It's also called Capital Asset Pricing Model, CAPM. And now if we have the risk-free rate, which is the TB rate, right? And the market risk premium and the systematic risk beta, then we can use the CAPM model. The cost of capital equals to cost of equity actually equals to risk-free rate times the beta of this equity times risk premium of market. Then we can use this required return as a cost of equity. So example is the company's equity beta is now 1.2. Current risk-free rate is 7%. Expected market risk premium, which is the difference between market expected return minus risk-free rate, is 6%. Then we can use the CAPM model. Cost of equity equals to now risk-free rate plus beta of the equity times market risk premium, right? Then this is going to be risk-free rate plus beta times market risk premium equals to 14.2%. So that's another way to calculate cost of equity. This also pros and cons, and the advantage is now it show risk, which is the beta. So it directly shows the beta as a systematic portion of the risk. Now it's applicable to all companies as long as beta is available. Doesn't matter whether this company pay dividend or not. As long as we have beta, then we can use that. Now there's a number of also disadvantages for this model. You must estimate expected market risk premium, which does vary over time. This changes actually. So this is hard. Now we have to also estimate beta. Beta is also not fixed. It varies over time too. And then also rely on the past information to predict the future. So which means that, past is good information to predict the future, but it is not always true. So it is not always reliable if the past information is skewed or flawed, things like that. So these are the disadvantages for the CAPM model. So this is another example to calculate the cost of equity. Now there is a beta, market risk premium, risk-free rate, and then this is the growth rate, and last dividend and current stock price that we can actually using two models separately to calculate the cost of equity. So the cost of equity for CAPM is the risk-free rate plus beta of the equity times market risk premium, right? And this is the cost of equity. and the 6% is the market risk premium. And I'm sorry, 9% is market risk premium, and 1.5 is beta. So we have 9.5% cost of equity. Now, the next one is the dividend growth model. We can also use the dividend growth model. So cost of equity equals to D1 divided by P0 plus G. So D1, now we have to only have D0, not D1. So we have to estimate D1 is actually D0 times 1 plus G. Then divide by price and plus the 6%, and it's going to be 19.55%. So based on the information you have, you can use either one to calculate the cost of equity.